Welcome back to the channel. In this video we're discussing Amazon stock and why this is one of the best Magnificent 7 to own for the next 5 years. Amazon year-to-date performance is plus 7% compared to Apple plus 16%, Google plus 15%, and Microsoft was of course sold off with other SaaS stocks minus 21%. Everybody knows what Amazon owns. I will not go into details, but Amazon has many different segments including online stores, third-party services, Amazon Web Services, advertising services, subscription services, physical stores, and other services. You can pause the video and have a look in details what is the latest quarterly results for all these segments. But I want to pay your attention here on this chart. Here you can see Amazon's revenue and revenue growth in percentage. So the line is showing the growth decelerating or accelerating. And here you can see the growth peaked in March 2018. And if we have a look what happened in the chart of Amazon stock in March 18, it's exactly here. After 5 more months, Amazon stock peaked, and after that we had consolidation for almost 2 years. And then coming back, we have another drop, we have another deceleration in revenue from 43% basically to less than 10%. And this happened again in March 2021. Coming back to the chart again, March 2021 is exactly here. This is again when Amazon stock peaked, and after that we had consolidation, and after that we have even dropped of north of 55%. So the key lesson here is the stock is going up when the revenue is accelerating, and the stock is going down when the revenue is decelerating. And the reason is very simple, is because when the revenue is accelerating, the Wall Street doesn't really know where this revenue will peak. So they project continuously acceleration. But when the revenue is decelerating, they also don't know where will be the bottom of deceleration, and they also project two negative scenarios. That's pretty much how it works. So you want to own stocks where the revenue is accelerating. This is exactly what we have here. The revenue deceleration bottomed at 721%, and after that we had a plateau, and now revenue is accelerating to 16% in a latest reported quarter. Another thing I like about Amazon is that stock-based compensation peaked and started to drop. It peaked in 2023 and now started to drop. Currently we are in kind of plateau, but I believe this will continue to drop. It's still quite significant number. You can see north of $20 billion per quarter in stock-based compensation. It's a lot of dilution for the shareholders. But what is really nice to see is that this number keep going down. Of course, the bear case for Amazon is that they are investing too much money into the capex, building AWS capacity, and all this will not have return on investment, and AI is pretty much bubble. If you believe that, probably you shouldn't own Amazon stock. I don't believe that. I believe AI is real. I believe AI is driving real efficiency improvements. That's why I believe that Amazon will be one of the best positioned company in the future to take advantage of the future where every website, where every enterprise, where every client, individual client is using different AI services for their work, for their life, and so on. Huge capex investment, of course, is leading to negative free cash flow. We already saw this in 2021 until 2023, and based on the chart, the chart is quite ugly at this period. So if you believe that this will repeat, probably the Amazon is not for short-term investors. From the positive side, we continue to see a reacceleration in AWS growth. In the latest reported quarter, it's 28.43%, and I believe in the next quarter Amazon will continue reaccelerate the revenue for AWS. And this is from the latest shareholder meeting, where CEO is saying that now their chip business is over $20 billion, and if this will be standalone business, the annual run rate would be north of $50 billion, which is absolutely amazing to see how Amazon is improving efficiency and reducing the cost for the AWS using their own silicons. Another very nice thing to see is Amazon advertising services growth is also reaccelerating. Currently kind of in a plateau, but at least not going down, growing 24% a year over year in the latest reported quarter. I recorded a video where I went through the bear case, how the agentic e-commerce could be the bear case for Amazon advertising business. You can go to watch the video, I'll attach the link, but the long story short, in case of agentic e-commerce, people will not go to Amazon.com to serve or search for something they need. They will directly search in ChatGPT or Gemini or Claude, and they will get the recommendation directly from this layer. That's why the Amazon will not be able to get those high margin advertising business anymore in this case. Amazon is one of the largest robotics plays in the market. Amazon currently has north of 1 million robots. From 2024, they started from almost zero, and fast forward to today, 12 years later, they grew to 1 million robots. Absolutely outstanding. So if you want to have exposure to robotics market and you don't want to risk with the companies who is building humanoid robots or with a company who is building picks and shovels for humanoid robots, I think Amazon is one of the best, safest play on robotics, because robots will definitely improve the efficiency for Amazon's warehouses, and finally Amazon can drive their operating margins even higher. Talking about operating margin, in December 16 gross margin was 35%, and currently right now the gross margin in the latest reported year was 50%, and operating margin has similar story from 3% to 14%. Here significant operating leverage for Amazon, and robotics is only starting, so I believe this will continue to improve the margins for Amazon. I'm quite bullish on Amazon. I have 3 cases. In a base case, I expect 160% return in the next 5 years. In a bull case, I expect 233%, and in the bear case, I expect not lose money, but still makes 33%, which is a 6% CAGR, which is usually average for S&P 500. So even in the most bearish case, where I project the revenue growth of 10%, operating margin of just 20%, which is not improved from current operating margin, and price to operating cash flow even lower than now, from 18% down to 15%. So this is as bearish as it gets, compared, for example, to bull case, where I project 14% revenue growth, operating margin improving to 25%, and price to operating cash flow of 25. In this case, we can get 233% return for Amazon stock in the next 5 years. The reverse DCF is showing that Amazon's free cash flow, implied free cash flow growth, is north of 23%. If we imply that current free cash flow for Amazon is not $7 billion in 2025, but $40 billion, because you can see the free cash flow dropped in 2025 because of capital expenditures. But if we align the growth from 32, if we assume that free cash flow for 2025 optimized free cash flow will be $40 billion, then the implied free cash flow growth is 22, almost 23% for Amazon stock, which can be achieved with a revenue growth of 13% plus improved free cash flow margins. Something I didn't pay too much attention previously, but currently looking more and more at technicals. I believe this can significantly improve your performance and allow to outperform S&P 500 and also Nasdaq. Currently, the Amazon is still in uptrend from 2023, making higher lows and higher highs, which is very healthy to see. Until this uptrend is broken, we don't need to worry too much about that. And if we have a look at moving averages, one of the most important is 200 days simple moving average or exponential moving average. Currently, this fat blue line is 200 days exponential moving average. We can see that Amazon just went through and then with a huge volume just bounced back. And currently, Amazon is overtaking 200-day moving average. It's too early to say, but this is a very healthy price reaction. Amazon respected the uptrend. Amazon made another higher low. Amazon respected 200 days exponential moving average. So I believe for now, bulls have nothing to worry about. All the theses are intact and Amazon continue to execute. Meanwhile, Amazon is one of the most optional company in the world, with Amazon Leo reaching critical mass of 394 operational satellites in orbit. Also, Amazon Zoox unveiled the next evolution of its robotaxi. This is the car you can see on your screen, how it looks like, and it basically has a lot of space. I would not say this looks too luxury, But for people who can just go from point A to point B, I believe this is totally fine and you don't need the driver. So if we compare, for example, Waymo, Zoox for Amazon and Tesla, Waymo has level 4 autonomy. Zoox also has level 4, which means fully autonomous. And Tesla has still level 2, which requires driver to supervise the car during the self-driving mode. Summarizing here, Amazon is the largest position in my portfolio. I believe in the company. I am loaned for a long time. Now I have both equities and LIPS for next year, for June next year. I believe after Wall Street recognize the AWS growth, after Wall Street recognize the margin improvement due to efficiency, due to robotics, Amazon will be re-rated, the valuation will be re-rated from price to operating cash flow of 16 to price to operating cash flow of 23 or even 25. In this case, this will significantly re-rate the company and stock will be north of $350 per share by the end of the year. Thank you so much for watching. Let me know in the comments below what do you think about Amazon stock and I will see you in the next one.